I have the honor today of running this discussion with two good friends, colleagues on the FIMM board, Dato Teng and Mr. Danny Wong. Dato Teng, as you, anybody that's involved in the unit trust industry would know, is the managing director of Affin Hwang. And it's one of the most successful unit trust firms in the country. And then, of course, Mr. Danny Wong runs a very boutique, a very niche company called Areca that has been around for a long time and known for its innovative products. You may have read an outline of today's topic, which I actually want to try and put in a little bit of context. Or maybe fair to say that I just felt it was a little bit too wide. Given the volatile circumstances that we face and the market difficulties that we are going through at the moment, I thought I would want to refocus the attention to how it would impact our market with our industry based on our products. And that would be very useful for you. So I would like to address some questions first to Dato Teng and then to Mr. Danny Wong. But in the questions that I addressed to Dato Teng, I would like to also invite Danny for any questions that you or any comments that you may have at the end of it, if there's anything that you want to add, and vice versa later in the second set of questions. So without wasting any more time, I have these very broad questions which I would like to allocate maybe 10 minutes for Dato Teng to start with in relation to a few key challenges that we are facing at the moment. So as we all know, the markets have become very volatile with much shortened cycles. Why do you think that this is happening? And if I can just add on to that, what are the key factors that contribute to this phenomena? And does it signal that we are likely to have a global recession in the near future? So let me pass it on to Dato Teng, please.
Thank you, Ridzal, for those questions. A very good morning to all of you. Let me try to answer those questions in a perspective of what we already have seen in the last 10 months or so, globally, what has been unfolding. I think clearly we had benefited over the last 12 years prior to this from what we then known as quantitative easing, zero interest rate policy, and the economy functioned what they call a Goldilocks event, where you have low interest rates, reasonable growth, low inflation. Today, for the first time in the last 12, 14 years, we are facing a reversal of something that we have enjoyed for a good part of 14 years, especially the last 2 years. When we had COVID-19 globally, the governments had no choice but really to use both fiscal and monetary policies to support the economy. As such, there were lots of incremental spending by the governments around the whole world, and monetary conditions were let loose in order to accommodate growth. Today, as we look at the markets, as we experience, is a complete reversal of that environment. And that itself is giving rise to increased volatility, as we've seen in the marketplace. I guess we had it very good for 2 years, where prices were just rising in terms of asset prices. Today, we are going to go through another cycle where markets have to determine, there are a few things. Number one, how long will this high inflation period last? Number two, what is the outcome of it? How much of it will impact the real economy? There will be impact, but how much of it will be filtering through? And number three, there are then increasingly choices for cash. In the last 2 years, you hear people say, cash is trash. Today, cash is king again, because interest rates have gone up. I mean, it's phenomenal. You have not seen, if you are saving money in Sing dollar, in the longest time, you'll probably be paid close to 0% interest rates on your Sing dollar deposits. Today, they are talking about 3%, having 3% interest on Sing dollar. And that's phenomenal. That's so different over the last many years. I think these are things that will evolve in the marketplace, and these are things that the markets have to grapple with. The other point I'd like to highlight is that the other big risk that we are seeing, big swings in the marketplace, came around with geopolitics. Now, geopolitics is something that cannot mathematically be programmed into your systems. It causes lots of volatility because the outcomes are very binary. Whether it's the Ukraine crisis or even the recent one, the mini budget in UK, very unexpected, right? Out of the blue, we had this mini budget in UK. And what happened then? Then you realize that suddenly the long end of the bond market in UK spiked up massively. And next thing we know, unintended consequences happen. That a lot of pension funds in UK are facing margin call, arising from the swaps that they entered into in their asset liability management. And these are things that are causing lots of volatility, and I can't imagine if the UK government had not reversed some of this position. Some of the pension funds would have gone bust in a matter of weeks. And these are really real events that were unfolding that caused intense volatility in the marketplace. And I think geopolitics is not going to go away. In fact, it continues to be something that we have to keep in mind, given the heightened relationship between US, China, US, Russia, the West, and the East, and things like that will continue to play out over the many years to come. The last point I'd like to highlight really in terms of this phenomena that we are seeing in volatility is that yes, indeed, the big R word is recession. The way markets are moving in terms of what they are pricing is expecting a recession sometime in the next 6 to 12 months. The big storm is coming in. Then how do you manage your client's portfolio? How do you advise your clients? I think there are two ways of looking at it as we face such an environment. Typically, unit trust investments are meant for longer term. I have invested my own savings in unit trust, and I've decided, let's ride through the storm, although it's painful, right? Sometimes you say it's a smarter thing to do is to sell now, buy later, but most of the time, when you try to do so, you tend to miss out the markets as they turn. The other interesting opportunities I see is really in the form of the bond funds, because we have seen, as I explained to you, with interest rate rising, we have seen yields rising in an interesting level, to the interesting levels. And today, for savers, there are now more options. In the past, when interest rates were close to zero, you only left with equity as one possible options. Today, with interest rates as where they are today, I think there are lots of interesting options on yield-bearing assets for investors to consider.
Thank you, Dato. Is there anything you would like to add to that, Danny?
Good morning, everyone. I'm very much in line with aligned with what Dr. Teng has said. Maybe the market is pointing to more uncertainty, therefore is more volatile. And at the same time, market has gone through many cycles, and then market always in cycle, and it will, whatever up and it will come down, whatever down, it will go back. I have not seen any market fail to rebound. So there are always, the media preachers, the doom and the gloom in the news and whatnot, But having said that, I think we have to look at beyond the short term and go for long term. Yes, there are a lot of people saying that, market is very bearish and then we will go into a recession. Well, we have gone through many rounds of this kind of disasters, and we survived each of the recessions, right? From 1975 to 1982, 1991, and 2009, we survived every crisis. And in fact, every time we went stronger, and until today, actually, index actually going higher and higher. So we have to understand about the cycle. The cycle we have been, from the accumulation stage to markup stage to distribution, and then now it's actually a markdown stage. Could be already bottom, it could be not yet, so we don't know. So we cannot predict, the recession will come or not, whether it's a soft landing case or a hard landing case. However, I think most of us actually gone through this many rounds, like what Dato say. We cannot predict what will happen, but what we can do is actually we strategize ourselves for long term. We diversify ourselves into different asset classes. Each of the scenario or market phases, we have assets to invest, and we have to sometimes ignore certain assets and go into the other assets, or we just stay the course with our strategy asset allocations and go for long term. And eventually we see our portfolio actually growing better than we are panicked in this kind of situation. I think, the last thing I want to say is actually on this topic, is that I think the World Bank has not really come to a point that project any global recession, judging from October 2022 global outlook. But yet, I think we are all very prepared that next year could be worse, and it could be enter into recession. Hopefully, it's a shallow one and short one, then we can go back. But market always move forward, always 6 months, 9 months ahead. So we are already pricing most of the bad news. So let's see what will be after this, and whether we are actually, following the media and where always preach the doom and gloom, and then we give up hope and then sell at the wrong state, and then eventually market rebound. We miss all these things. Let's not time the market and ride on it. In fact, you could see a better future then.
Thanks, Danny. I think for most of us of this vintage, we've been through a few cycles already. It's never as bad as you think it is, never good as people always say. One interesting thing that was raised by Dato Teng was that there are a lot of geopolitical issues. Most of these conferences, we tend to stay away from those kind of issues and stick to market forces, but I think it's unavoidable. And there was a very interesting talk last night with Farid Zakaria, where he was talking about the differences of Russia and China, where way back when, during the Cold War, they were not major economies. But today, with the problems that they're having with the West, these are, particularly in the case of China, a major economic force. So there's a difference. I think there's concern that the friction between these countries are going to hopefully doesn't cause problems, but they predict that it's actually heading that way. Let's see what happens. I think you have already jumped ahead of the gun, where you have asked, the audience has asked questions where, are there any strategies for fund managers to reduce the impact of inflation? How long will the global inflation persist when you think it will stabilize? So I think some of those questions have been answered. You might want to answer the question on the impact of inflation in their investment returns. I think that's quite good. And this is the $50 million question. What do you think about the impact of the coming Malaysian elections on the Malaysian stock market and economy? Okay, so I'll put that out for both of you.
Maybe I answer the one that is easier to answer. The impact of inflation on your investments. I think what we can see is that with inflation, central banks globally, they have been so slow to address it. Today is trying to catch up and trying to keep their credibility, in my view. Right? They have been so accommodative in the past to believe that growth is important for them. However, they have actually slacked in controlling prices. The Ukraine crisis basically disrupted supply chain globally. And today we have seen commodity prices have gone up, and then finally it got passed through to the end consumer. There are two parts to it. The good news is that I think the disruption on supply chain is easing. We have seen it worldwide, right? I mean, you talk to builders on aluminum prices, steel prices 6 months ago, and today you know prices today are back down. Not back to pre-level, but at least it has eased and supplies are coming in. But we are still seeing that tail end of the effect of higher prices. When we have inflation, we have interest rates, what it happens is that it reprices the asset prices. That's what it does. Essentially, when we used to value companies, how do you value companies when the long-term interest rate is 2%? You can put a valuation of 30 times, 40 times, and it's still reasonable because your alternative is a 2% return on your long-term bond. If a long-term bond trades at 6 to 7%, it completely throws out valuation. Then at 15 times, 16 times, that's probably would be the fair valuation. And that's what's happening in the US market today, where the markets are repricing at the moment the valuations relative to the long-end bond that is traded at 4% today. That's how the adjustment takes place. The other point I like to make on inflation, I'm of the view, I may be wrong, but I'm the view that inflation has peaked and it's coming down. The problem is it's coming down very slowly, right? It's no longer going, I don't think it's going to rise higher than what we've seen in the middle of the year. It's coming off in US, even in US it's coming off. But the pace of decline is not what the market wanted to see. The market would like to see a much faster pace of decline. However, if you look at the core inflation in US, 1/3 of that increment came from rental increase. Now that's sticky. When you have rental increase that contribute 1/3 of the core inflation, it will take a while for that to ease in terms of the incremental contribution to inflation rate. So we have to be patient. And I think by next year, even if you have this conference again next year, you will then hear that, oh, inflation is down, Fed is behind the curve, now they need to cut rates sometime by end next year, and the market by then will adjust to economic cycle and the repricing again. Maybe then you want to take the election?
Well, right. Maybe I'll just add on a bit on the inflation. My view is very much in line. Also, I think the inflation is peak, and also think that the Fed cannot continue hike the rates. Given that no longer those days like 1980s where the Fed rate could have touched 20% when the inflation was double digit. I don't think so today we will have this kind of scenario because the modern monetary theory actually should take place, and then they will flood the market with money. When actually too much money, then they will just tax the market and then take back the money. This is similar to the rest of the world. So I think inflation is here to stay also because of the new changes. I think everything could be very pricey now. So back to the impact to the market, especially to our investors and even myself, I don't think so we can rely on our passive or rather our active salary alone. That may not able to catch up with the prices. Our salary increment is so slow that our price is actually gone too far away from what we are earning today. So come to a point where we will have deficit if we don't do anything. So we have to change, right? I think we have to really do, for some of us actually have a second job for secondary income. Some of us actually have to make our money work better. So no longer those days that you just keep our money passively and that's it. So I think this is a key point. We have to advise our investors to continue catch up with the inflation rate by making the money work, right? So then whether recession, don't recession, the money, if you invest it in the right asset allocations, it will produce something that actually meaningful to catch up against the inflation. So we may need to be active investing nowadays rather than putting the money in a very low yield environment moving forward. So that's my view on the inflation and the impact to the market. And the tough question on the local, I don't see local politics will end by this election. It will keep on develop and develop. Because we are in the developing country, and then we need to really make our, our political scenes more matured than, like the rest of the developed market. So we are going through the phase of maturing political scene. So it will evolve, years after years. So this round, I don't see any big event on this, whether whoever be the control the majority, right? So, but I hope there's no hung parliament. I don't think so. There will be one. So if any, there will be maybe a coalition government. But I think there will be a simple majority, and that actually make us our job easier, because one uncertainty has been removed. To me, election is a good news. That at least we remove one uncertainty from whatever that is actually cause the market volatile. So once the uncertainty being removed, we are actually less by one, and then we focus on the other 2 or 3 maybe in the market. So maybe if a Fed, like what Dato Teng say, that if Fed actually taking a stand that, oh, now maybe the recession risk is higher, we have to take care of it, then maybe slowly moderate the rate. I think that should be welcomed by the market. And then the other one is war. War is always there. Geopolitically always there, right? So we have to just be careful. But of course, this round is actually causes more damages, right? While the other factor is actually the big power like US and China, will they slow down? Now that will also impact the global trades. So this is something that we need to look at it. But I'm not very, very worried about this, because no matter how the outcome of the market, there are assets to be invested. Like what Dato Teng said, we will be very cautious on the bond market past few years because of the yield are very, very low, right? And then they're only putting up in the future. But now already up. So what will be the next? So it could be down, So it could be there's an asset class that we should look at. So no matter how the market moves, we can have our strategic allocation to the right sector. Of course, we don't trying to, put everything into one basket. We diversify into a few asset class. Even equity itself, I may not be very bearish at this. I'm sanguine that there are still sectors that beneficial from this kind of environment. Like, for example, rate hike, I'm sure everybody knows that bank will benefit a lot. And then Bank Negara will maybe have to catch up with the rate. So with the next 1 or 2 meetings. So that also may give some kind of margin, expansion for some banks to make more, and then the loan growth as well. So there are sectors that will benefit from that. And the rate cut, of course, you will benefit all the high yield products, that you can capture at the yield, at the peak of the yield, and then you ride on the capital acquisition eventually. So there are always things that we can invest. There are always things that we can also advise investors to stay put with our current portfolio. So in long short, I think the rest of the factor is more important than election. I don't think so. Election will be causing a lot of things here. Yeah. That's my view.
Thank you, Danny, Dato. I think the only comment about the elections, not just the Malaysian elections, is that markets prefer certainty. And every time you have markets, elections, where it creates more questions than answers, it may be volatile. In fact, one of the more important elections that we should maybe be taking note of is the midterm elections in the US. Because if you have the Democrats out of control of the Senate, and it essentially means that the administration for the next 2 years will find it very difficult to push economic measures across. And that has a global impact. Yeah. So yeah, we'll see what we see with what comes up with our own domestic politics. Hopefully, a more cogent administration over a period of time, rather than this start-stop kind of thing. Okay, let's move on. I have a set of questions for Danny, but I'd also like Dato Teng to chip in if he has some additional comments on it. How will these market volatility and uncertainties affect unit trust and the PRS industry specifically. And what advice would you give to unit trust and PRS consultants and investors in current market conditions? I think some of that you've alluded to already. How can the investing public prepare itself to face a volatile and uncertain market environment? Over to you.
Firstly, I think the impact to the market always there, the sentiment. There are a few things affecting the market: liquidity, risk appetite. These are, I think, always in short term affect the valuation and therefore affecting the market sentiment or the investor sentiment. And today there are many, I would say, noises, which is not really good, and we hear too much and read too much. Sometimes we just stick to what we believe and what we are holding on for long term that could drive us through all these uncertainties. So sentiment is the main factor that causing the volatility and today affecting some of the investors. I think as consultants, as advisors to our investors, this round is actually a very good test for us. I quite like Warren Buffett. What he said is that when the tide goes away, then you know who is swimming nakedly, right? So you have to go through the portfolio that some of the investors are overly exposed to certain sectors, right? Then you know there are too much risk towards certain things. Then it's a time for you to go back to investors. This time you see this is the real test. Maybe your portfolio to be overly exposed to certain type of asset class. It's time to rebalance and strategize yourself for long-term growth, right? This is something that is always good. And then, of course, don't act like an investor guru in the, some of the website and internet, right? We are not really, we are here to stay for long term. We don't disappear, when market is bad and appear only when market is good. There are some investment guru always like that. Wow, they appear everywhere when market sentiment is very good. But look at today, I think most of them disappear. We are not them. So we are here to stay. This is a time where we hold our investors' hand and go through this. I think more so, investors will like us to tell them so much of what are we going to do, not so much on what happened, right? So investors like to see us to hold their hand and say, here, this is a strategy, move forward. This is what they want to hear, rather than say, hey, this is my portfolio negative. No, they don't. Most investors, they are all reasonable. They just want us to give our piece of advice. Of course, they will not take all, but at least they want to see what is our view and what's our strategy moving forward. So always go through this time of market. To me, I've gone through many this one around, and then it helps me. It is actually give the trust, create the trust among us, between us and the investors. And this is around that we can show that we always hear when market is no good. So when market is good, never mind, because everybody will become to be investment guru and advise everybody, But this round, not many. And this is a time that we should show that we are here for investors, right? So what investors are supposed to do, I think we have shared some already just now. I think it's time to look at the portfolio, whether not totally time the market now, right? But at least look at the risk side of it, whether we are already exposed to certain sectors or asset class, then strategize it again. It's okay to look forward rather than look backward, because looking backward, you see, wow, so many losses, then you don't want to do anything drastic. But actually, it's time to look back and know whether you have exposed certain risks. Now is to adjust again and move forward, because important is look forward rather than look backward. So some of them will say, oh, I'm too painful to cut loss, or too painful or too fear to go into the market. It's actually not so much on timing the market, it's actually more on asset allocation, whether the outcome of this portfolio is actually suits your needs and your risk. So if this risk-reward ratio is balanced, that is a time for you to move forward with this kind of asset allocation. All right, thank you.
Thank you. Anything you would like to add, Dato?
Yeah, I guess one of the experience I had in the last few months, fully agree with Danny that, look, this is a time for you as consultants to go out there and really advise your clients and hold their hands, to guide them through this difficult period of time where markets are volatile and uncertain. I had opportunities to meet a lot of clients during this period of time, and typically what I advise them is that really if you can't sleep at night with your investments, then it's time to make some adjustments. If you can sleep well, then just continue on with the journey. That's the gauge I use. And true enough, the number of them said I couldn't sleep. I said, then why not make some adjustments? Now, these are all irrespective of where the markets were. And after we have done the adjustments, and when when we go back for review again, after a number of months, they're a lot more comfortable that they made such adjustments. Maybe because the market went down. That's why they said, wow, I made a good decision to reduce risk. But I can say this, regardless of what the way the markets will be, whether up or down, because you're not going to cut out completely, you're just making some slight adjustments on the asset allocation, they'll be very comfortable, right? Because at least they know if they need to de-risk so that they can rest at night, let them de-risk, right? Then put in some fixed income or lower volatile asset class so that they can then review it as the markets unfold over the next few months. And that's what I've gone through over the last 6 to 9 months with a lot of clients.
Thank you, Dato. We actually had a similar discussion at last year's FIMMAC, where we were talking about upskilling the benchmark strengths of consultants, and this is where your skills will become important, because as mentioned by both Danny and Dato Teng, I mean, during the good times where everything is going up, you're just selling, right? But this is when your advisory fees are actually the advisory fees that you really need to work for. So let me just go to a couple of questions which I will direct to our panelists. What do you think our ringgit depreciating against other currency on the capital market and economy giving the increasing inflation rate? So I assume the question is about what is the impact of our depreciating ringgit. I know it's depreciating against the US dollar, not necessarily against other currencies. So would somebody like to comment on that?
Well, I think as Malaysia, if I spend most of the time in Malaysia, I wouldn't see any impact, right? But other than, of course, direct impact, indirect impact would be our goods become more expensive, especially those imported goods, right? It's by paying the same amount of dollar, but we have to make more, we have to pay more ringgit. So that's the fact of it. So imported inflation is actually is all this while we cannot feel it. Cannot be directly pinch our pocket, but you can feel it that we have to pay more for certain goods that used to enjoy cheaper last time, right? So that is actually, of course, the other thing is actually when we used to travel or maybe have children abroad, that will be the time that you feel the pinch, right? So much, especially in US, then you have to pay, from 4 ringgit to $1 today is actually nearly 4.7 to $1. So you will see almost like 20% increase. So that's actually, you used to pay maybe $10,000 for your children's school fee. Now you have to pay maybe slightly higher, about maybe 12,000. So 20% more, indirectly 20% increase. So that is the impact to us, in terms of inflation. Imported inflation, as well as you travel overseas, you feel the pinch. Of course, on long run, when you already plan for retirement, because of higher inflation, because of you need to travel the world, whatsoever, your retirement plan got to readjust a bit, because it will affect you because of you have planned it. Maybe your retirement plan could be 20 years ago or 10 years ago, and with the inflation rate is so much reasonable. Today is no longer that, so you have readjust a bit. Either you have to make your take a slightly higher risk to adjust your growth so that you can achieve your goals, or you have to cut short certain expenses, cut certain expenses so that you still maintain your retirement plan in check. That is something that you have to really look at it. So I think long short, the weakening ringgit also have some implication to our longer plan.
Maybe, Chairman, I'd like to add that I'm just thinking a very good question on how does the weakening ringgit impact inflation in Malaysia? I believe there is impact, right? I mean, Malaysia import, if I'm not mistaken, 60-70% of what we consume are imported. And when you look at imports, they're not priced in ringgit, neither are they priced in, I think predominantly are all priced in US dollar, right? So by large, you will see that coming through. However, one thing that you do notice in Malaysia, why you don't really feel as much, is because we run a very subsidized economy. The government, to a certain extent, has subsidized a lot of things in Malaysia. That's why we don't see that hyperinflation numbers coming through Malaysia. Your rice are subsidized, your sugars are subsidized, your electricity is subsidized, your gas that you pump in your car, they are all subsidized. The question is really for us, how long can this subsidy go on, right? And then the question also, is subsidies a better use of the budget or development is a better use? And the answer is very clear. Development is a better use of the budget rather than just a pure subsidy. Yes, the B40, the M40 needs help. We need to keep prices low for them. But that shouldn't apply to the T20 because they can afford to pay for it. How then do we change the system or revamp? That's for another discussion altogether. So I think we don't feel as much is because of the subsidies that the country runs. The other point I like to say is that I think where the direct impact on the currency weakness to dollar will be in the gas prices. And should the gas prices rise in any big way, transportation price will rise, and then that eventually you'll filter down to your kopi o price in your coffee shop. I think that's probably the fastest translation if I would look at from a layman perspective of inflation.
The McDonald's benchmark. Yeah, okay, so let's go to another question. And I guess this is alluding to the banks. So there's a comment, not quite sure what the question is. Banks are so strict in lending, so rigid, requesting for 2 years earnings, which is the MCO period, during the MCO period, I guess. Most housing loans failed. What's the expert's view? So basically here, I think it's asking whether we have structural integrity in the banking and finance system, particularly, I guess, when things are going bad, where there's going to be constriction in terms of consumer usage and bank loans and this kind of thing. Do you see that happening?
I think banks has been really cautious on lending to housing, consumer housing. I think that's something that we have seen not only for these last 2 years, but I think prior to that they were quite concerned of the oversupply situation at the housing markets in Malaysia. And I think they've been encouraged by certain regulators to relax or to consider supporting the housing market. Unfortunately for banks, I believe the first and most important responsibility for all banks is to really protect the depositors. That is the cardinal rule of banking system. Should we not have discipline in our lending and the depositor starts to feel the pinch because NPL start to rise, we're going to have a big crisis in hand. It's just not about lending to individuals. So my sense is that our banks in Malaysia, thanks to Bank Negara, they have been very prudent in their approach towards lending. And despite COVID-19, when we expected NPLs to rise in a rapid manner, we hardly had that. There was some rise, but it's just very manageable. So I think, while yes, certain segment of the markets need help in terms of credit, I think we must be disciplined at the other extreme, the other end, to make sure that our system remains robust and stable.
Allow me to add something on this. I think beside bank is a proxy to economy, and the banks is actually very important to an economy. So if the banks fail, I think there will be a repercussion to the economy. I think you look at the subprime crisis, that will be a very, very big lesson to us. We are just simply lending it out to those who are not, not within the lettable environment, or those who are with a lesser or very weak credit. Then we have this issue subsequently. When small storm come in, then everybody will get affected, and those who are with a good credit will also bear the damage. So this is not what we want to see. I think it's a good thing for us to be disciplined for ourselves, being a borrower. So we build our own credit. The moment we have good credit, I don't think so bank will not lend to us. In fact, banks are happy to look for good credit guys. And then they love to say, I mean, not me, but some of our friends that with a good credit, they always get call from bank, hey, do you want me to give me, you don't even need to have collateral. I give you maybe 100,000, 200,000 kind of, personal loan without any collateral. That means that this person must have very good standing in terms of the credit with the bank. A bank loves to lend to you because they know your credit. So it's a good thing for us to, this round, or even in future, to build a good credit. When you have a good credit, you are not worried about bank to lend to you. That's a key point. And make sure that the bank continue to be healthy in this environment, so that even the recession will come, we still can survive, because the bank survive, we can survive, and we can get loans from bank eventually.
I totally agree. I think that's an even more important factor of confidence than even the elections, right? you have you need to have a sound financial environment. Let's go to another question, and then maybe we can wrap up, where essentially it's asking, given the assumption that we are going into a recession, how would a fund manager take advantage of it? I mean, you're basically being counterintuitive and trying to take advantage of a difficult situation.
I think into a recession, there's no doubt that most of the asset prices will decline. The question is, how do we protect the portfolio as much as we could? Of course, then you said, okay, I buy some defensive stocks. Then what is defensive stock? There's no such thing as defensive stock into a market that collapsed. Remember in 1998, during the Asian financial crisis, you thought public bank is the most defensive stock. Guess what? It dropped 70%. Now that's the type of crisis prices that we've seen. I'm not expecting an Asian crisis happening in this cycle. I'm not. I think we are going to go through a recession, and it's just a repricing of asset prices. We are used to valuations that are very high for a good part of 14 years. Today, we need to make some adjustments to those expectations. And markets may have another 10, 15% to decline. And that's probably what we see, what we may going to see, right? Because of these adjustments. And there will be slower growth. There will be earnings cuts as we go into next year. But some of these are starting to be priced by the market anyway. So I think as fund manager, what do we do in terms of this type of phenomena? Is other than just really going to defensive stocks that have cash flows, try to avoid companies that are highly leveraged, and then look at cash as a buffer in the portfolio so that you can reinvest when prices are much cheaper. Then the other way of running a defensive portfolio is really from asset allocation. From your perspective, from your client perspective, is really you allocate your assets correctly. Rather than 100% in risk asset class like equity, you can then shift into 50% into equity, the other 50% into 25% into cash, 25% into bonds, and this will weather you through where the portfolio will decline in a much lower pace. I'll give you an example, right? We had an income fund that runs 30% into dividend stocks and 70% into fixed income. And I was just looking at the number, year to date, the fund dropped 6%. While it's a lot to me at 6%, it looks a lot, but actually you look at in the whole scheme of the market this year, that 6% is still a very tolerable level. If you have invested in the pure equity funds, you will probably be down, my guess is about anywhere between 10 to 15% this year. So I think that's how you defend your position, by treating the asset allocation so that the decline gets slower as the market decline.
please.
Yeah, maybe I would like to add on to this is that actually, when we first approach a client, we understand the client's risk profile very well. And then, you know, when clients started to invest, they always say that, okay, I can take this risk and therefore I buy into this equity, right? So over time, they've forgotten about what they said. I can take this risk and then ride on this for long term. When a person invests in equity, they know that the equity tends to be ups and downs, right? And they already price in this journey ups and down in between. And ultimately what they want is maybe 15 years, 20 years down the road, I want this return. You already, as an investor, already make your mindset very well, say that I am going to ride through this long term, and then there will be ups and downs, there's bumps in between. But I'm okay because long term I want to achieve this, I want to stay with this, and then want to achieve, let's say, a 10% per annum over the next 20 years by having exposure into, let's say, an equity growth fund or equity dividend funds or equity funds, whatever is that. But then they're forgotten along the way. So we, as a consultant, we have to really remind investors, say that the moment you started to invest, you know that it's not a straight line all the way like that. There'll be ups and downs. You already prepare your mindset that I'm okay to ride through this up and down. But why you're panic at this moment? So you shouldn't do any drastic if you can sleep, right? So you forget about that. So you buy next door piece of land, you don't revalue it and look at it every day. You look at it 15, 20 years later to sell, or 10 years later to sell. You don't look at it next day or tomorrow or a day after, right? So leave it there if you're okay. Of course, you cannot. Then, of course, you're just a bit on your risk because then you may be, you know, overly exposed to certain risks, right? So back to the initial questions, where I think for us, fund managers, how we can you know, do this thing. In fact, fund manager actually know better than you and me and everyone. The only difference is actually we spend more time than you, that's all, right? Not that we are wonders, we know everything. If not, then we'll be very rich by now, right? It's just that it's our profession to look at the market, to spend time, to do more things than what you cannot do, right? So this is our job. That's why you delegate your money and with us to invest it. In this time, you know what to do, right? Whether we're buying, switch some high-risk assets to the low-risk assets, you know, do some tactical adjustment here and there, maybe keep some cash and then deploy the cash when time is right, and then buy into some value stock that which, you know, like what Dato Teng said, at this moment, I'm looking at cash-rich company with good fundamentals. So if really the deep recession comes, I'm not that bad. Not that I won't lose money. I'm not that bad. But then I still have cash. I can still go into certain sector and buy value, or I still holding that value stock because the moment I know I'm holding something that it will not collapse and one day will bounce back even more beautifully, why should I do anything at this moment? So I should continue even if I buy certain stock at $10 today, drop to $8, make more sense for me to even buy more because it's cheaper at this moment. So our job is quite easy to look at, of course, easy in the sense that to look at the price. So we think that $10 we are convinced to buy, why not $8 if the fundamental doesn't change? Unless the fundamental change, then we swap to other stock. That's our role. We spend time to monitor, to study those things. So leave this thing to the fund manager the moment you already dedicate to fund manager and you sleep better. That is our always the advice to investor. No worry, we know what to do because we have more time to do that than you, right? For you, just do your normal job. Leave this to us. We will know what to do.
Thank you, Danny. We have 10 minutes left. I want to thank all the questions that have been coming through the audience. Some very good questions. Unfortunately, I can't go through all of it. I actually want to spend the next 10 minutes getting down to a working level. We've been talking at macro views and, you know, what inflation will do. I would just like your take, maybe for a few minutes, in terms of what kind of work would you expect consultants to do in a very difficult time? Stick close to your clients, what advice you need to give them. Obviously, the more difficult the situation is, the closer you need to be with your clients. Maybe I can start with Danny first.
Yeah, that's actually very crucial for us and very good questions indeed. As I just now shared that actually, we have to realize that inflation is here to stay. indeed, the real inflation is actually much higher than the reported inflation figures. And those who stay in the town area is far more higher than those who, of course, in kampong or rural areas. And we have to readjust, look back. As an advisor, we have to look back and look at our client's portfolio, whether for example, whatever retirement plan or certain target or goals is still achievable. We have to readjust ourselves for that, right? And the other thing is actually, things has changed so much with the digital economy, with actually, aging population, right? And with the youngster mindset, we are very different today compared to 20 years ago. The younger generation now, they're willing to look at certain things as that's non-conventional. So they're more acceptant to cryptocurrency. They're more acceptant to certain, online things. They're more, they trust people from online that they know that without physical face-to-face. That kind of mentality mindset is very different from the old days, like my generation, the baby boomers. The baby boomers, on their hand, still stick to what they believe in. So when we meet our client, we have to know, baby boomer, so their job is actually to protect the asset so that it will not be, affected by inflation, and then the money that actually built actually depleting because of high inflation rate and low growth. So we have to look at this area. Whereas for the younger generation, more advisable is actually to diversify, because younger generation means that they have maybe not as much money accumulated unless they got inherited from their parents. But when whatever the hard-earned money, they tends to put the money into certain risky stocks. And that is something that we have to advise investors to diversify and build a long-term portfolio. Maybe it's okay for you to expose certain asset classes into the alternative assets, right? But not all in. It should diversify into something that, even that one goes down, you are still okay because you still have this one. And this supposed to be, built for your retirement, for example. So always work on a diversified portfolio rather than, avoiding them or advise them not to go into other assets, because their mindset is actually they can go anyway. Why you stop me, right? But it's just that it's our role to say that, okay, maybe I'll diversify a bit. It's okay to accept this alternative asset. It's okay to go for conventional asset. Diversify. Diversify in the sense that not having 100 assets class. No. Diversify in terms of risk. If this asset class goes up, the other asset class will go down. But if the other asset goes down, you are still okay with this up. You balance your overall risk, and that's still okay with you in long run. So that's diversification. Not so much on having 100 or 1,000, that's diversification. No. It's actually the risk characteristic of each asset classes. It's one move up, the other thing, one move down, the other thing actually move up, then you balance up your overall risk.
I think a lot have been covered by Danny in terms of what, I guess, consultants like yourself and even for myself, I also and actually go down to meet up with clients. It's actually really not to disappear when times are bad. That's probably not the right approach towards this business. If you are into this business for a longer term, one positive light that I can always see about this industry is this. Most of our clients invest for the long term, right? I remember telling people this story about my grandma, that's no longer around today. When I saw her investment in one of the mutual funds, that she put 10,000, I think she invested for 15 years, through ups and downs. And she decided not to look at it until the day she's no longer around, and it became an inheritance for the children. And that's the nature of Malaysians, which I think is very phenomenal that you don't see in a lot of countries, where Malaysian investors tend to invest for the much longer term for their retirement. But that said, into this environment is where we need to, if there are clients who are concerned, who wants to have discussion, I guess we have to be there with them to hold their hands and guide them through this difficult phase. Second point I like to make is that tough times like this don't last, actually. There are always brighter days in the markets. I've been in this business for 30 years. I've seen a lot more good years than bad years. If I have a lot more bad years, I will not be in this business at all, right? We have more good years than bad years. And if I'm not mistaken, out of every 10 years, we probably have about 6.5 to 7 of good years, and probably 2.5 of bad years and 1 year of just not doing too much. So I believe it's still the same. There are more good years than bad years. And I don't think, just that the cycles have gotten shorter, and that's why we feel so stressful. But otherwise, over time, I think that probability still stands in my view. So I think just need to understand that we are very deep into this cycle. This is not new. This is not something that just started overnight where Fed is raising rates. They've been raising rates for a while, and I tend to believe that we are probably closer to the end than the beginning of the interest rate cycle. It may be still painful the next two cycles, the next two hikes, but we are probably closer to the end. I can't see that they will be able to raise it too much from there. And then by then you will see inflation tapering, and eventually the impact on the market, on the economy will be seen, and the market will start to price forward, and things hopefully by sometime next year should have a more normalized cycle. Thank you.
Thank you. Dato Teng, Danny, I think we've had nearly an hour's worth of a very good discussion. I think, during difficult times when we are expecting a rough 2023, everybody in this industry will need to work harder, work smarter, and perhaps just like we began in the opening remarks, we need to start considering to reset, and particularly our sales force. So I would like to commend both the speakers. I think the comments have been really on point. I think during difficult times, this is when people really make a difference in terms of whether they are professional advisors or whether they suddenly disappear and conveniently come back when the bull market comes back. So for an industry that's been around for 30 years, I guess my only parting words will be, we need to stick close to our clients. This is the time when they need us the most. This is the time where they need reassurance. This is the time where they will need ideas for new strategies. And I'm sure our investor, our sales base, along with the unit trust companies, will be supporting each other to make sure that we meet the challenges coming in the months ahead. So with that, let me thank everyone for participating in this panel discussion. I saw very many questions. I apologize for not being able to cover all of them, but I hope you've enjoyed the session. Let me pass this back to Anita, our host for FIMMAC 2022. Thank you.